Right now, in 2026, if you walk into your bank and deposit more than $10,000 in cash, your bank is legally required to report you to the federal government, no matter how honest you are, no matter how long you've banked there, and no matter your age. Most Canadian seniors have never heard of this rule, and that's exactly the problem, because misunderstanding it can cause real stress, frozen accounts, and even delays to your CPP and OAS payments if you're not careful. Before we go any further, if you find this channel helpful, please take a moment to subscribe to CPP OAS Weekly Update. It genuinely motivates us to keep bringing you accurate, up-to-date pension information every single week. Today, we're breaking down the FINTRAC $10,000 rule in plain, simple language. No confusing legal jargon, just what you need to know, why it exists, how it can affect your banking, and what it has to do with your CPP, your OAS, and your GIS. By the end of this video, you'll understand exactly what triggers a report, what doesn't, and how to avoid any unnecessary trouble with your bank. Let's start with the basics. FINTRAC stands for the Financial Transactions and Reports Analysis Centre of Canada. It's a federal agency. Its job is to watch for money laundering and terrorist financing across the country. It doesn't manage your CPP or OAS. It doesn't decide your pension amount. But it does work quietly in the background of every bank, credit union, and financial business in Canada. Here's the rule in its simplest form. Anytime you deposit, exchange, or hand over $10,000 or more in cash in a single transaction, your bank must file something called a large cash transaction report with FINTRAC. This isn't optional for the bank, it's the law. Now here's something many seniors don't realize, and it catches people off guard. This rule isn't just about one big transaction, it's also about smaller ones added together. If you bring in cash multiple times within a 24-hour window and the total reaches $10,000 or more, the bank still has to report it. This is called the 24-hour rule. So depositing $9,000 in the morning and another $2,000 later that same day still triggers a report, even though neither deposit alone crossed the line. Why does this matter for our audience specifically? Many seniors keep cash at home. It's a habit built over decades, often going back to a time when banks felt less trustworthy or less accessible. Some seniors received a cash gift from a family member. Others sold a car, a boat, or some furniture and were paid in cash. None of that is illegal. But if you walk in and deposit that lump sum, it will be reported. And here's a curiosity worth sitting with for a moment. Being reported does not mean you did anything wrong. Let that sink in, because so much fear around this rule comes from a simple misunderstanding. A large cash transaction report is not an accusation. It's not a red flag against you personally. It is simply a routine piece of paperwork that financial institutions are required to file. In most cases, your money is deposited normally, your account works exactly as it should, and life goes on. The report happens quietly behind the scenes. So why does this cause so much panic among seniors? Because of one dangerous mistake called structuring. Structuring means deliberately breaking up a large cash amount into smaller pieces specifically to avoid triggering a report. For example, depositing $4,000 on Monday, $4,000 on Wednesday, and $4,000 on Friday, hoping to stay under the radar. This is not a clever workaround. It is a serious federal offense. Even if the money is completely legitimate, even if it's your own retirement savings, intentionally splitting deposits to dodge reporting can lead to your funds being frozen and, in serious cases, criminal charges. The safest approach is always the simple one. Deposit your money normally. Never try to outsmart the system. Now let's connect this directly to your CPP, OAS, and GIS, because this is where things become especially important for our viewers. Many seniors ask us the same question every week. Does a large cash deposit affect my OAS clawback or my GIS eligibility? The direct answer is no. FINTRAC reporting itself has nothing to do with how Service Canada or the CRA calculates your pension income. FINTRAC and the CRA are separate systems built for separate purposes. But here's the part that quietly trips people up. While the cash transaction report itself doesn't touch your GIS, the money you deposit might. If that cash represents income, such as the sale of an asset that generated a capital gain, or interest that had built up outside a registered account, it may need to be reported on your tax return. And remember, for the current period, the OAS clawback threshold sits at $95,323 of net income for 2026, with 15 cents of every dollar above that clawed back from your OAS. GIS is even more sensitive since it phases out completely once a single senior's income passes roughly $22,500 for the current quarter. So the real question isn't the cash deposit itself, it's whether that money counts as taxable income once it lands in your account. This is exactly why so many financial advisors quietly encourage retirees to draw from a TFSA whenever possible. Withdrawals from a tax-free savings account do not count as income for either the OAS clawback or GIS calculations. So if you're moving money around and want to avoid any impact on your pension, understanding where that money came from matters far more than how you physically deposited it. Let's pause here for a moment, because there's something else worth knowing that catches many seniors completely off guard. The $10,000 rule doesn't just apply to banks. It applies to real estate transactions, casinos, life insurance companies, and even precious metals dealers. If you've ever paid a large cash deposit toward a condo, made a cash premium payment on a life insurance policy, or purchased gold or silver with cash, the same reporting rule applies there too. This becomes especially relevant for retirees who are downsizing. Perhaps you're selling your family home and receiving part of the payment in cash from a private buyer. Or maybe you're helping a grandchild with a down payment and the funds pass through cash at some point in the chain. In every one of these situations, once $10,000 or more in cash changes hands, a report gets filed automatically. Now, some of you may be wondering, what about e-transfers, checks, or wire transfers? Here's an important clarification. This specific rule is about physical cash, coins, and banknotes. It does not apply to checks, money orders, or electronic transfers in the same way. Those larger transactions can still draw scrutiny under separate anti-money laundering rules. But the $10,000 cash reporting threshold specifically targets physical currency changing hands. So if you're depositing a government check, a pension check, or transferring money electronically between accounts, this particular rule doesn't apply. It's the physical cash that triggers it. Here's another detail that surprises many of our viewers. Foreign currency counts too. If you've recently returned from visiting family overseas and you're bringing back foreign cash to convert and deposit, the bank converts that amount into Canadian dollars using the Bank of Canada's exchange rate to determine whether you've crossed the $10,000 threshold. So even foreign bills sitting in an envelope from a trip abroad fall under this same rule once deposited. Let's talk about what actually happens step by step so you know exactly what to expect if this ever applies to you. You walk into your bank with $10,000 or more in cash. The teller will ask for identification. They'll record basic details such as your name, address, date of birth, and the purpose of the transaction. This isn't personal, it's simply required information for the report. Your deposit still goes through normally. Your funds are available in your account as usual. The report itself is filed by the bank directly to FINTRAC, not to you, and not published anywhere public. In the vast majority of cases, nothing further happens at all. This brings up a curiosity many seniors don't consider. Did you know FINTRAC doesn't even decide whether you're guilty of anything? Its entire role is to analyze patterns and pass along genuinely suspicious activity to law enforcement. A single honest deposit from a retiree who sold their car or received a family gift almost never leads anywhere beyond that routine filing. It sits quietly in a database, used only if broader suspicious patterns ever emerge. So what should you actually do if you're planning a large cash transaction? First, don't panic, and don't try to break the amount into smaller pieces to avoid reporting. That structuring behavior is far riskier than simply depositing the full amount honestly. Second, keep records. If the cash came from selling a vehicle, a family gift, an inheritance, or downsizing your home, keep any paperwork, receipts, or written notes explaining the source. This protects you if any questions ever come up later. Third, if the money represents actual income, such as capital gains from an investment or asset sale, speak with a tax professional to understand how it may affect your net income for OAS clawback or GIS purposes. And finally, consider whether a bank draft or electronic transfer might be more convenient for very large transactions, since it avoids the need to carry large amounts of physical cash altogether, which also happens to be safer from a personal security standpoint. Here's one more thing worth mentioning before we wrap up, because it ties everything together. FINTRAC has been actively increasing enforcement in recent years, issuing penalties against businesses that fail to file these reports correctly. This means banks and reporting entities are being more careful than ever. So if you're making a large cash transaction in 2026, expect the process to be followed strictly, with more questions asked at the counter than you might have experienced years ago. This isn't something to fear. It simply means the system is working exactly as it's designed to. Understanding rules like this one matters more than ever for seniors managing retirement income, because confusion often leads to unnecessary anxiety, and sometimes even bad decisions like withdrawing funds and hiding them at home instead of keeping them safely in a bank. Knowledge really is protection here. If this video helped clear up some confusion for you, please give it a thumbs up and leave a comment letting us know what pension or benefit topic you'd like us to break down next. Your questions genuinely shape what we cover here every week. And if you haven't already, please subscribe to CPP OAS Weekly Update so you never miss an update on the rules that affect your pension, your benefits, and your financial peace of mind. Next week, we're going to look closely at how GIS resets work each July and what documents you need ready before that happens. Take care of yourselves, stay informed, and we'll see you in the next video.